Good day, everyone. I am Eduardo T. Andaya from BSBA 2B, and we are the group 5. We are going to tackle about receivable management. But before we discuss the topic, let's have our lesson objectives. First, we have disseminate the credit selection process from the quantitative procedure for evaluating changes in credit standards. Second, evaluate cash discount changes, credit terms, and credit monitoring in improving a firm's performance. Third, compute accounts receivable that could be free from the operators. Fourth, appreciate how accounts receivable policies that help the management in improving a firm profitability. And lastly, make decisions involving accounts receivable management. To start with, so we have here the concepts of receivables. Receivables represents the amount of money to be collected from individuals or firms. So when we say receivables, it is represents the money that is owed to a company by its customers or clients. So it is the amount that individuals or firms owe to the company for goods and services that provided on credit. So like for example, si customer ibalit og product worth 100 pesos on credit. So, ang kanang 100 pesos, may mo siyang receivable for the company until the customer pays the amount. So, second definition of receivables, we have receivables arises from the sales or merchandise or the performance of services and granting of loans to officers, employees, and stockholders. So, receivable arise when a company sells goods, they provide services or loans money to officers, employees, or stockholders. So, this means that the company is owed payment in the future. Like for example, if a company sells a product to a customer on credit, no, the payment will be received at a later date. So to proceed, no, we have here the general classes of receivables. We have two general classes of receivable, which trade receivables and non-trade receivables. And under the trade receivables, we have the usual types of receivable, which is the account receivables and notes receivables. So first, we have the definition of trade receivable, which refers to claims arising from the sale of merchandise or services in the ordinary course of business operations. So this means that if a company trade receivables, it allows them to convert sales into cash quickly, improving their cash flow. So, like for example, a clothing retailer sells clothes to customer on credit. So by trading these receivables, so the company receive cash upfront and use it for various business expenses. So when we see accounts receivables are open account or those not supported by promissory notes. So um, accounts receivable that are open account are those do not have a formal written contract or promissory note that is supporting the debt. So they are based on a verbal or implied agreement for payment between the business and its customers. Like for example, a business retailer extending credit to a regular customer without any written agreement. So like sabot-sabot lang, no? Regardless on the notes receivable are those supported by former promises to pay in the form of notes. So these are also formal documents that represent promises by customers of borrowers to pay a specific amount by a certain date. So these notes provide written evidence of the debt owed by the customer to the company. Like for example, if the company lends money to a customer, so who signs a promissory note that agreeing to repay the loan within a year, so that promissory note becomes a note receivable for the company. So when we say non-trade receivables, it represents claims arising from sources other than the sale of merchandise or services in the ordinary course of business. So this means that the non-trade receivables are claims that came from sources other than the typical sale of goods and services, and they usually include no sa mga loans sa mga employees, mga insurance claims or mga rental income. Like for example, so if ang company mo loan og money sa usa ka empleyado nga mag-expect og repayments, so ang kanang loan mahimo na siyang non-trade receivable sa usa ka company.
Good day, Miss Jen. Good day, everyone. I am Claire Bantilan, and I'm one of the reporters of Group 5. My assigned topic will be the factors that affect the size of receivable, accounts receivable management, and float on receivable. Before I formally start, let us first define the factors that affect the size of receivable. So when a firm refers to the size of receivable, it usually signifies the entire amount of money due by its clients or customers. So when a term that is widely used to describe accounts receivable, the several components of circumstances that impact the amount of money that is overdue and has not yet been collected by a business are the factors that impact the quantity of receivables. So kani siya, these variables kay nag-include like term credits, customer payment behavior, collection procedures, and credit sales volume, all of which have an overall effect sa company's total quantity of outstanding receivables. So to put it simply, these variables influence how big or small the accounts receivable amount appears on a business financial statements. So ang first factor nga maka-affect sa size of receivable is the term credits. So now diri it define nga the level of accounts receivable depends on the length of the term credit. A common expectation is that the longer term of the sale, the higher the level of the accounts receivable. So it likely refers to term credit or payment that a company extends to its clients. It implies that the amount of accounts receivable though may be impacted by the duration of the credit period or ang amount of time consumers are given to pay for their purchases. So in general speaking, what is said about a business offering longer credit terms, allowing clients to pay after 60 days instead of 30. So, much example. So, this could result in a bigger amount of accounts receivable. So, this is due to the longer payment terms that clients have, which could cause a delay in the company's cash stream. So, in order to maintain a healthy cash flow, so you can minimize the risk of late payments or bad debts and give consumers flexibility. It's critical for businesses to handle credit conditions wisely. Next factor is the payment practices of the customers. So firms with customers who prolong payments are expected to have a higher level of receivable. So ang kaning customers' payment habits na siya big influence on how much a company has in accounts receivable. So a higher quantity of accounts receivable is probable for the company if customers persistently miss payments or take longer to settle invoices. Companies frequently have to find a balance between luring clients with good credit terms and making sure they properly handle their receivables. Businesses use a variety of tactics to keep a healthy balance between cash flow management and customer happiness, including monitoring and influencing customer payment behavior through clear credit policies, efficient communication, and even providing incentives for early payments. So, ang third factor is the collection policies. Firms with a level lenient collection policy have a higher level of receivable than firms with a stricter collection policies. So a company with a lenient collection policy, one that is less rigorous or flexible when it comes to following up on past due payments. It tends to have more accounts receivable. So a stronger collection approach, on the other hand, that entails more proactive steps to guarantee on time payments, can aid in controlling and lowering accounts receivable. So the maintenance of a sound cash flow is contingent upon the efficacy of an organization's policies and practices regarding collection. So the likelihood of late payments and bad debts can be reduced with the help of a clearly planned and regularly implemented collection procedure, which will eventually increase the company's overall financial stability. So the last factors is the volume credit sales. Firms that mostly grant sales on credit have a higher level of receivables. So kana siya, the amount of accounts receivable is directly impacted by the volume of credit sales or how much a company sells its goods or services on credit. A company's level of receivables usually increases when a sizable element of its sales are made on credit. So this is because there is a delay between the sale and the actual receipt of cash since clients are given a length of time to pay for their items. Giving credit for sales can draw clients and boost revenue, but it's important for businesses to handle this part while to strike a balance between increasing sales and keeping a healthy cash flow. This entails putting in place sensible credit standards, keeping an eye on how customers pay, and having efficient collection methods. So, akong next topic is the accounts receivable management. So, unsa man ni siya? So the accounts receivable management, like any composition of assets, accounts receivable must be properly handled to efficiently achieve the firm's goal of maximizing its stockholders' wealth. So kaning accounts receivable management, essential ni siya to enhance a business financial stability and advancing its main objective of increasing shareholder wealth. Maintaining a balance between giving customers credit for sales and making sure that timely collections are made are key components of effective accounts receivable management. So, kaning effective management of accounts receivable helps a business maximize shareholder wealth by ensuring consistent cash flow, lowering the risk of bad debts, and improving financial stability. To continue, receivables management is the process of determining, handling, and administering accounts receivable related to sales and credit policies. So, receivables management entails the methodical process of identifying, managing, and controlling accounts receivable in compliance with the business credit and sales standards. So, this procedure is essential for preserving a positive cash flow, lowering the possibility of bad debts, and guaranteeing the company's general financial stability. A number of components go into efficient receivables management, including defining precise credit conditions, assessing a customer's creditworthiness, issuing timely and accurate invoices, putting collection procedures in place, and using technology to expedite procedures. A business can achieve financial success by effectively controlling these factors in order to strike a balance between providing credit to customers and making sure that receivables are collected on schedule. So, akong next na sad is the floats on receivables. So, ang kaning float is one of the factors nga maka-influence sa accounts receivable. Float is an element that may have an impact on accounts receivable. The amount of time that money takes to move between accounts during a transaction is referred as float. So regarding accounts receivable, float can affect the time lag that occurs between a customer's payment and the business actual receipt of the funds. A prolonged float indicates a delay in revenue collection for the organization and could result in a bigger amount of accounts receivable. Effective methods for managing receivables seek to reduce float by optimizing payment, processing, and collection processes nga maka-enhance sa cash flow. Float exists from the time goods are sold or services are rendered an account. Float can persist until the relevant payment is paid, starting from the moment items are sold or services are provided on account. This time frame includes all phases of the payment process, such as invoice mailing, customer processing and payment initiating time, and company processing that follows to credit the monies to the account. So it is imperative to reduce this float period in order to manage receivables effectively. So in order to shorten the time it takes for sales to become actual cash inflows, businesses frequently work to optimize their payment, collection, and invoicing procedures. The enhancement of cash flow and financial efficiency is facilitated by this optimization. So, mao to siya akong topic guys. Thank you for listening and watching. Hope you learned something from my discussion. So let's go to our next reporter, Miss Elma Alimorin.
Hello everyone, I am Elma Alimarin and today I am going to tackle about trade credit. So, what is trade credit? Trade credit is an agreement between two businesses which allows customers to purchase goods and services to supplier and pay for it later. Trade credit is when business allows its customer to purchase goods and services and pay for it at a later date, creating a kind of short-term loan. For example, if a supplier offers a net 30 trade credit terms, it means the buyer has 30 days after receiving the products to settle the payment. During these 30 days, the buyer can use or sell the items before having to pay for them, which can be helpful for managing cash flow. Another example sa trade credit is kanang mga Avon, Natasha, and personal collection, which is they allow their customer to purchase their products and pay for it later. Usually, gihatagan nila 30 days or 1 to 2 months ilahang customer para mo pay sa item na ilahang gi-purchase. But, depende gihapon kung unsa na item ilahang gi-purchase. And sulod anang 30 days trade credit terms na nasabutan after nimo ni purchase sa item, ang customers is na sila katungod na i-personal use ilahang i-purchase na product or ibaligya nila og lain. As long as after 30 days kay mobayad sila sa ilahang i-purchase na items. Firms invest in accounts receivable through trade credits for the following purposes. First, to increase the current sales volumes. Firms granting trade credits like to achieve growth by increasing its customer base. For example, imagine a small business offering a buy now, pay in 60 days credit terms. Customers get excited about the delayed payment and might purchase more products than originally planned. For instance, retailer buying inventory with this arrangement can stock up on additional items leading to higher current volume. For example, let's go back sa kato ako ang first na example, which is katong Avon, MSE, and Personal Collections, which ga-offer sila og buy now, pay later. So kung typical Pinoy decisions, kung makadungog bang dag purchase karon, unya bayad pohon halago. Kuan dayon purchase dayon taog daghan kay madani magud ta when basta makadungog taog buy now, pay later. Like, sige, makauna, masod si motok. Like, sige, mag-purchase kong daghan kay dili pa bitaw karon ang bayad. Sige, mag-order kong daghan ana kay kanang makatigom ra kog ibayad kay itagaan mo kag like for example tagaan kag 30 days para mabayad ka na imong i-purchase na items. So like murag makuan ka ba? So ma-encourage jud ang mga customer na mo purchase og daghan. Like kay dili man diha mo pagawas og money dayon di ba kay buy now pay later man. So mo na kanang ara mo increase ang current sales volumes kay daghan mag mo purchase since dili pa man sila mo bayad dayon sila hang mga gipang purchase na goods and services. Second, to retain current sales. The main purpose of this move is to prevent company from losing its customers to competitors. Businesses also use trade credits to retain their existing customer base. When firms offer favorable credit terms, such as extended payments periods, it builds customers' loyalty. So sometimes pod, para makadani og mga loyal customers ang usa ka business, sometimes mag-offer na sila og extension sa payment. Like let's just say for example, 10 days extension sa imong due date and something nya, which can build loyalty band sa customers og sa supplier kay madani man ang customers kay kanang gitagaan man sila extension di ba kinsa may dili madani anangin ana na offer, right? So, mo na ilahang buhaton to retain the current sales sa ilahang company. So, that's it for my part, everyone, and thank you for listening. The next part of our report will be reported by Miss Genessa Tito.
Good day, everyone. My name is Genessa Tito, and for today, we're going to tackle about bad debt expense, variable and fixed cost, cost of capital, and cash discount. So, if you're planning to have a business or you already have a business, make sure that you're wise enough to identify the cost involved before giving or granting someone a trade credit or simple as utang. So, the first one is bad debt expense. So, bad debt expense recognized when a receivable is no longer collectible because a customer is unable to fulfill their obligation to pay an outstanding debt due to bankruptcy or other financial problems. So, bad debt expense is a rendered service or products to a certain customer but he or she weren't able to pay you in return. So for example, I have a Lipton business, and I have four customers: customer A, B, C, and D. But unfortunately, customer B weren't able to pay the products that I gave to her due to financial problem. So that's what we call bad debt expense. If someone weren't able to pay the certain service or product that you gave to your customer. So the next one is the variable and fixed cost. So variable costs are expenses that directly and proportionally the changes in business activity level or volume. So variable costs changes directly and proportionally. So if the production increases, then the sales will increase. If the production decreases, then the sales will decrease. So it varies. It varies to the changes in business activity level. While for the fixed cost are the expenses that remain constant for a period of time irrespective or the level of outputs. So fixed cost will not change over time. So it will remain constant for a period of time. So the example of fixed costs are the rent, lease payment, and the salaries of a permanent employee. And for the variable cost are the raw materials or the utilities like electricity. So we won't be able to define the electricity bills that we're going to receive because sometimes the power would increase, and also a water bill. That's also one of the example of variable cost. Next one is the cost of capital. So cost of capital measures the cost that a business incurs to finance its operations. It measures the cost of borrowing money from creditors or raising it from investors through equity financing compared to the expected returns of an investment. So, the cost of capital refers to the cost of company incurs to finance its operation through various sources of funds including equity and debt. So, if you're planning to have a business, the first thing that you're going to have is the capital. Whether it's from your pocket or from your investors or somewhere, as long as you have your capital. You cannot start a business without a capital. And in return, you also need to prioritize your investors because because of them you were able to have your capital in which you build your business. So the last one would be the cash discount. So cash discount is a reduction in the amount of an invoice that the seller allows the buyer. So everyone knows discount. Everyone knows cash discount, right? So cash discounts is a reduction of the regular price. Like for example, the regular price is 530, but they discounted it and it becomes 499. So that's what we call cash discount. Another online platform that would be an example of cash discount is the 1111, 1212, 11.
Good day everyone, I am Luigi in Tagalog and I'll be continuing our report. Credit policy. Credit policy is our set of rules and standards that can direct how companies can grant credit to customers and collection method. Credit policy is also established by a business or a financial institute to govern its approach to extend credit to clients. It is also addressed how the company will manage and mitigate credit risk. Term credit. Term credit refers to a batch business regularly launched towards the designated collecting banks by the paying banks, which is entrusted by the payer in accordance with the agreement they signed before. It refers to a systematic approach where a paying bank regularly initiates batch payment or refers to the duration or length of time that a customer is allowed to take before making payments.
Good day, everyone. My name is Janet Herante, and I'm going to discuss the relaxing term credit, incremental working capital requirements, and shortening the credit period with a discount offering. So, first, relaxing term credit. It refers to a practice in which company extends the payment period or offers more lenient terms to its customers for setting their invoice or debits. It involves granting customers more time to make payments beyond the standards of previously agreed upon terms. So, ang purpose aning relaxing term credit is to provide the borrowers with temporary relief during challenging financial situation, such as economic downturns or personal hardship. It aims to support individuals or businesses facing financial difficulties by offering them more manageable repayment options. So next is incremental working capital requirements. Are the additional funds or capital that company needs to support its increased level of operation resulting from a specific business decision or change. They represent the extra working capital necessary to finance the incremental activities undertaken by the company. So, the incremental working capital requirements can be calculated by analyzing the change of various components of working capital. So, like for example, no, if ang company nag-expect sila nga ilang sales is mo increase. So, ang ilang buhaton is to invest more inventory to meet the higher demand. So, mo nilang buhaton. And it is important for businesses to carefully manage their working capital requirements to ensure they have sufficient liquidity to meet their operational needs. So next is shortening the credit period with a discount offering. Is a business strategy where a company reduces time frame in which customers can make payments for their invoice while providing them with a discount incentive for paying earlier than the standard credit terms. It is important for the business to carefully consider the potential impact of offering earlier payment discount. They need to assess the financial implication such as the impact of profit margins and ensure that the discount offered is reasonable and sustainable. Additionally, businesses should communicate the discount terms clearly to customer to avoid any confusions. And that would be all. Thank you.
Good day, everyone. I am Madeline Grace Acormo, and I will be discussing the credit standards and the 5 C's of credit. So let's define first what is credit standards. It refers to the guidelines followed by the company in giving credit sales to the customers. So these are the guidelines and criteria used by the financial institutions to assess the creditworthiness of potential borrowers. Credit standards help lenders evaluate the risk associated with lending money and make informed decisions about whether to approve or deny a loan. So next, there are 5 C's of credit, which you can see in your screen right now. So first, let's define what is character. So character refers to the moral and ethical quality of individual who is responsible for paying the loan. It is generally based on past credit records. So this refers to the borrower's reputation and trustworthiness. Lenders assess the borrower's credit history to understand their past behavior in repaying debts. A positive credit history with timely payments and responsible financial behavior will reflect on the borrower's character. So next, we have the capacity. So it is the applicant's ability to pay off the credit extended as judged by the financial statement analysis focusing on cash flows available to pay debt obligations. So this assesses the borrower's ability to repay the loan. Lenders evaluate the borrower's income, employment stability, and existing debt obligations. So they want to ensure that the borrower has the financial capacity to meet the repayment terms of the loan. So next, we have the capital. It is the level of financial resources available to the company seeking the loan. So capital refers to the financial stake in the investment. So lenders look at the borrower's net worth and how much of their money they have invested. So a higher capital investment by the borrower indicates a stronger commitment to the investment and may increase their creditworthiness. So next, we also have the conditions. It is the current general industry specified economic states and any unique situation surrounding a specific transaction. So conditions involved external factors that could impact the borrower's ability to repay the loan. So lenders consider economic conditions, industry trend, and the specific purpose of the loan. So understanding these conditions help lenders to assess the overall risk associated with the loan. And lastly, we have the collateral. So it consists of assets pledged by the customers. So collateral is the assets that the borrower pledges as security for the loan. So in case that the borrower defaults, the lender can seize and sell these assets to recover the loan amount. So collateral provides a form of protection for the lender, especially in situations where there is a higher risk associated with the loan. So these concepts collectively provide a comprehensive framework for lenders to evaluate the risk and make informed decisions when extending credit to individuals and businesses. So I think that's all for my topic, and let's proceed to the next reporter. Thank you.
Good day, everyone. I am Shawnee Rose Cabusas, and I am about to report about the sources of credit information. But first, what is sources of credit information? So, it is expected that when a firm tries to loosen its credit standards, new sets of prospective customers will start flocking to get orders. And when it decides to do so, the firm has to choose whether or not to give trade credit to these customers. When new customers place their orders, the firm, knowing little information about them, will be reluctant to extend credit. The company has to gather credit information that will help it decide whether to grant credit or not. So, sources of credit information refers to the data and records that lenders and financial institutions use to assess an individual's creditworthiness and determine their eligibility for loans, credit cards, or other forms of credit. Here are some sources of credit information that the company may use in making a sound decision. First is financial statements. It is not unethical for companies to ask for the customer's financial statement, especially if they are not too familiar with the customer's company. Financial statements could provide a good credit analysis for firms that intend to get credit. Financial ratios like liquidity ratio, asset utilization ratio, and profitability ratio can give an initial impression if the company is capable of paying its credit. Financial statements are an important source of credit information for lenders and credit grantors when assessing the creditworthiness of individuals or businesses. These statements provide crucial details about an entity's financial health, including its income, expenses, assets, and liabilities. Lenders use this information to evaluate the borrower's ability to repay debts and make informed credit decisions. Types of financial statements. The main types of financial statement used in credit assessment include income statement, also known as a profit and loss statement. An income statement provides information about an entity's revenue, expenses, and net income over a specific period. It helps lenders assess the borrower's profitability and ability to generate sufficient income to meet financial obligations. Next is balance sheet. A balance sheet provides a snapshot of an entity's financial position at a specific point in time. Lenders used the balance sheet to evaluate the borrower's liquidity, solvency, and overall financial stability. Cash flow statement. A cash flow statement shows the inflows and outflows of cash during a specific period. It helps lenders assess the borrower's ability to generate cash and manage its cash flows effectively. Last is statement of retained earnings. The statement shows changes in a company's retained earnings over a specific period. It helps lenders understand how profits or losses are retained or distributed within the entity. Second is credit rating agencies. Reports from credit rating agencies is another important source of credit information. These credit ratings agencies sell information to subscribers containing the credit performance of many companies from different industries. In the Philippines, a well-known credit rating agency is the FEL Rating. With an increasing demand for information, foreign firms like Standard and Poor's and Merrill Lynch are also present in the country. These ratings are used by investors, lenders, and other financial institutions to make informed decisions about lending money or investing in securities. The major credit rating agencies include Moody's Investor Service, Standard & Poor's or S&P, and Fitch Ratings, often referred to as the Big Three. Credit rating agencies plays a crucial role in the financial system by providing independent assessment of credit risk. They analyze various factors such as the borrower's financial health, repayment history, and economic conditions. To determine the credit rating, the ratings are usually represented as letter grades such as AAA, AA, and A, triple B, and etc., with AAA being the highest rating, indicating the lowest credit risk. It is important to note that credit ratings are just one source of credit information, and they are complementary sources of credit quality information available as well. This may include factual information about alternative sources of credit quality information. summaries of research on credit ratings from various sources, and empirical work performed specifically for credit quality assessment. Additionally, individuals can also obtain their credit reports from credit reporting agencies like Equifax, Experian, and TransUnion, which provide information about an individual's credit history and creditworthiness.
I am Jaduk Lozano and I am going to discuss about the commercial banks, trade checking, and collection policy. So let's start off with the commercial banks. So commercial banks is a good source of credit information and as a form of service to their clients or clientele, banks actually provides crucial credit information towards their customer. And these banks could actually help you manage your financing, whether it can be in an investment like mutual fund or life insurance or just simply savings. So example of this are specifically here in the Philippines are BDO or Banco de Oro. We have the China Bank, Land Bank, which is a government type of bank. So let's move on. Let's move on towards the trade checking. So trade checking, it can be done by inquiring eminent customer or client their list of providers or suppliers, meaning it is some sort of survey towards their customers to know what is their capabilities or to find out what is their capabilities to pay on that exact date. Example is a universal bank conducts a survey to their new customers to identify their capabilities. That's what I said. On paying in the exact date. With this survey, they'll be more aware on offering credit to a new account, meaning they're not just also um, identifying the capability of a certain customer, but to also have this awareness on offering a new account to a new customer. Next is collection policy. So collection policy refers to the standards for monitoring and collecting receivables. The method of gathering is quite pricey, and to keep track of the document, the receivables, and to make decisions, employees must be hired. So, meaning employee must be hired, meaning this kind of tricky to do, especially when you're in a financial aspect of a business or simply in a bank, since this is can actually be also applied in banks. Example is the terms of payment, such as when the money is due, it might be specified in a collection policy. For instance, no, many of Javier's clients must settle their entire balance after 30 days. So meaning, this is actually a or like in a contract, this is a duration time of for a customer to pay to deposit their money towards the bank or and other collection procedures may specify that a bill will be paid in installments over time or that the whole amount is due after 60 days. So collection policy in short is more like an obligation to customers to fulfill on paying the exact date with an exact amount, whether it can be a minimum or maximum, to deposit money for a certain risk you make on a bank, either be investment or savings. So let's move on to the next topic.
Good day, everyone. I am the next reporter, so my assigned topic is all about evaluating receivables management.
Receivables management is a crucial aspect of financial management for businesses. It involves the monitoring and control of the amounts owed by customers, also known as accounts receivable. The three key metrics that we will tackle about is ratio of accounts, receivable turnover, and average collection period. These three key metrics are commonly used to assess the effectiveness of receivable management. So first, ratio of accounts receivable to net credit sales. This is used as a determinant to see if the company is too lenient or too strict in implementing its credit and collection policies. So the ratio of accounts receivable to net credit sales is a financial metric used to assess how effectively a company manages its credit and collection policies. This ratio provides insights into whether a company is being too lenient or too strict in extending credit to customers and collecting payments. So for example, suppose company ABC has an account receivable of 50,000 and net credit sales of 200,000. To calculate the ratio, divide the accounts receivable by net credit sales. So ratio of accounts is equal to accounts receivable over net credit sales. So 50,000 over 200,000 is equal to 0.25. In this example, the ratio is 0.25, indicating that 25% of the net credit sales are still outstanding in accounts receivable. A lower ratio might suggest that the company is efficiently collecting payments, while a higher ratio could indicate lenient credit policies or difficulties in collecting outstanding amounts. So monitoring this ratio helps businesses strike a balance in credit management for optimal financial health. So the second one is the receivable turnover. This formula tells how fast the accounts receivable are converted in cash. Receivable turnover is a financial metric that measures how quickly a company's accounts receivable are converted into cash over a specific period. It provides insights into the efficiency of the company's credit and collection processes. The formula for receivable turnover is calculated to divide the net credit sales by average accounts receivable. So if company XYZ has net credit sales of 1 million and an average accounts receivable of 100,000. So in this example, the receivable turnover ratio is approximately 10. So this implies that on average, company XYZ collects its accounts receivable nearly 10 times during the specified period. A higher receivable turnover ratio generally indicates more efficient management of receivables and shorter cash conversion cycle, which can be favorable for the company's liquidity and financial health. So the third one is the average collection period. The number of days of sales in the accounts receivable, a component of the cash conversion cycle. Average collection period is the average length of time starting from when the merchandise is sold until the payment becomes usable funds to the firm. So the average collection period is a financial metric that measures the average number of days it takes for a company to collect payment for its customers after a sale. It is a crucial component of the cash conversion cycle, representing the time it takes for a firm to convert a sale into usable funds. This metric is vital for assessing the efficiency of a company's accounts receivable management. So, for example, let's consider company XYZ, which has annual credit sales of 1 million and an average accounts receivable balance of 200,000. To calculate the average collection period, use the formula average collection period equals 365 days over receivable turnover. So using the previous example, if the receivable turnover is 10 times a year, the average collection period would be 365 days over 10 is equal to 36.5 days. This means on average, it takes the company XYZ approximately 36.5 days to collect payment for its credit sales. In this example, the average collection period for company XYZ is 36.5 days, so this means on average, it takes the company 36.5 days to collect payment after making a sale. Monitoring and managing the average collection period is crucial for optimizing cash flow and ensuring that the company efficiently converts sales into usable funds within a reasonable time frame.
So, good day everyone. I am Daniela and I will be discussing the next and the last topic of our group, which is the aging of account receivable and the desired level of receivable. So, for the aging of account receivable, it is one way of identifying clients who are paying their obligation within the prescribed term. So, in aging of accounts receivable, if there is a significant piling up of receivables beyond the normal credit term, a more stringent policy on credit and collections must be made. So, a company's account receivable are categorized based on how long a bill or an invoice has been overdue in a report called account receivable aging. It serves as an indicator for assessing the stability and financial standing of a business clients. So if the account receivable aging shows a company receivable are being collected much more slowly than normal, this is a warning sign that the business may be slowing down or that the company is taking on greater credit risk on its sales practices. So accounts receivable are aged accordingly and are properly classified into either not due or past due. So, the classifications are 1 to 30 days, 31 to 60 days, 61 to 90 days, 91 to 120 days, 181 to 360 days or more than 1 year, 121 to 180 days, and lastly, bankrupt or litigation. So in the example above, if we assume that the company's credit policy is 60 days, so then customer A, B, C and Co and XYZ and Co appears to be within the company's credit period. However, the company LM and Co appears to delay its payment to the company. So how management uses accounts receivable aging? So first, they use it in collection practices. So one of the ways that management can use account receivable aging is they use it to determine the effectiveness of the company's collection function. So if the aging report shows a lot of older receivables, it means that the company's collection practice are weak. So second, credit risk. So the account receivable aging report can also indicate which customer are becoming a credit risk to the company. So older account receivable expose the company to the higher risk if the debtors are unable to pay their invoices. So invoices like payment or bills. So lastly, allowance for bad debt. So management may also use the aging report to estimate potential bad debts during the reporting period. So they evaluate the percentage of an invoice dollar amount that becomes bad debt per period and then applies the percentage to the current period's aging report. So now we have the desired level of receivables. So account receivables are payments collected over a period of time. An acceptable timeline for collecting accounts receivable should not be more than 1/3 longer than your credit period. So, if a company desires to maintain a certain level of account receivable, the formula is receivable is equals to net credit sales over 360 multiplied by the required collection period. So, now let us have examples. So,
FLI company would like to maintain a balance of 450,000. So, in its account receivable account. So, if the company has a credit sale of 3,500,000 a year, what should be the required collection period of the FLI be? So, let us now try to calculate. So, as what I have said earlier, the formula is the receivable is equals to net credit sales over 360 multiplied by the required collection period. So now let us have the receivable. So the receivable here is already mentioned the 150,000. So let's put the 150,000 in the receivable. Next is the net credit sales. So just like the receivable, net credit sales here is also mentioned, is already mentioned. It is 3,500,000. So let's put the 3,500,000 in the net credit sales over 360,000 multiplied by the required collection period. So what we are trying to find here is the required collection period. So now let us try to calculate. So required collection period is equals to, so the 150,000 is moved in the right side, so it is now became 150,000 and then the 3,500,000 over 360. So in order for us to find the required collection period, we have to divide the 150,000 and the 3,500,000 and multiply it by 360. And if you try to multiply it right now or try to calculate it right now, the result will probably be 15.428 or something like that. Then rounded off, it will be 15.43 days. So that will be the required collection period. So that will be our required collection period. So, to sum it up, if the company wishes to maintain an account receivable balance of 150,000, the collection period should be 15.43 days.
That's all, guys. Thank you for listening.